She is looking at a wire transfer for $340,000 from a seafood import company in Naples to a restaurant supply distributor in Newark, and she already knows it's wrong before she finishes reading the client profile. The red flags are not subtle. The Italian company was incorporated 14 months ago. It has no website. The declared annual revenue is $2.1 million, but it has moved $4.7 million through the account in the last 6 months alone. The Newark distributor has the same registered agent as 3 other companies she flagged last quarter. The transfer narrative says invoice settlement, fish product, and the transfer hits on a Friday afternoon at 4:47, 11 minutes before her branch closes. The amount is $340,000, which is exactly the kind of amount that gets chosen specifically because it doesn't trigger the automatic escalation threshold. Structuring, classic layering, wire through 2 correspondent banks before it hits Newark. She knows exactly what the form on her screen is for, a Suspicious Activity Report, SAR, filed electronically through FinCEN within 30 days of detection, confidential, protected, legally required. She has filed 41 of them in 3 years on the job. She knows what this one would say before she types a word. She closes the client profile. She approves the transfer. She marks the case as reviewed and resolved, attaches a note that says documentation consistent with stated business purpose, and logs off at 5:02. She is 31 years old. She is the senior AML compliance analyst for a regional bank in northern New Jersey, with $8 billion in assets and an Italian-American client base that goes back 40 years. She has been doing this, the approving instead of the flagging, for 11 months. The family that owns the seafood company in Naples has known her father since before she was born. Her father came from Salerno in 1981 with nothing and built a small import business in Clifton, New Jersey. Olive oil, canned tomatoes, specialty goods from Campania. He was not a criminal. He worked 18 hours a day and sent money home to his mother, and eventually bought a house in Nutley, where she and her 2 brothers grew up. The community he moved in, the Italian-American businesses, the social clubs, the church, the informal network of men who knew each other from the same provinces and looked out for each other's families, was tight and specific, and she had been inside it her whole life without understanding that it had 2 layers. She went to Rutgers, finance degree, then a certification in AML compliance, then the job at the bank, which was a good job, a respected job, the kind of job that made her father proud in the specific way that immigrant fathers are when their children achieve things they could not. She was good at it.
The work is pattern recognition, learning what legitimate transactions look like and identifying what falls outside the pattern. She had spent 3 years getting very good at this before the pattern she started recognizing was one she wasn't supposed to recognize. The first time she noticed the accounts was routine, a cluster of Italian-incorporated companies with New Jersey correspondents, moving money in amounts just under the $10,000 cash reporting threshold, structuring, textbook, the kind of thing the software flags automatically. She pulled the profiles. She recognized 2 of the company names from conversations at her father's dinner table. She did not file the SAR. She told herself she needed more information. That was true. It was also the first choice, and the first choice is the one that matters most. The man who explained it to her was not threatening. That was the thing she came back to for a long time afterward, how not threatening he was. He was a family friend, a man who had been at her parents' anniversary dinner, who had given her a card when she graduated. He came to the bank on a Tuesday morning in a suit and sat across from her in the conference room and spoke quietly for 20 minutes, and the word Camorra was never used. What he explained was simple. There were certain accounts the bank serviced that had specific needs.
The documentation was legitimate, always legitimate, never falsified. She would never be asked to sign anything that wasn't real. What she would be asked to do, occasionally, was to not look too hard at transactions the system flagged, to review them, mark them resolved, and move on. She would not be creating anything. She would not be filing false reports. She would simply be exercising her professional judgment in the direction of not filing a report she did not need to file. She would be paid for this. Not in cash. She would never see cash. There was a consulting arrangement with a company she would never meet, which would pay a retainer to a personal account she would open separately. The retainer was $4,000 a month. Her salary was $74,000 a year. She asked what happened if she said no. He looked at her the way men of a certain generation look when they are disappointed but not surprised. He said her father was a good man. He said good men needed protection in business, especially in this economy, And that protection was something the people he represented had always provided to people who understood how things worked. She opened the account the following week.
She told herself it was temporary, which is exactly what people tell themselves when they do not want to know that it isn't. The first 6 months, she told herself she understood what she was doing. What she was doing, technically, was suppressing suspicious activity reports on transactions that met the filing threshold. The Bank Secrecy Act requires a SAR within 30 days of detecting activity that may indicate money laundering. She was detecting the activity. She was choosing not to file. This made her criminally liable for willful failure to report, which carries up to 5 years in federal prison per violation. She had suppressed 23 reports in 6 months. She told herself the transactions were ambiguous, that the documentation was legitimate, that she was exercising professional judgment, and that professional judgment was not a crime. She told herself that every compliance officer in every bank in America was making judgment calls constantly, and that the line between judgment and suppression was a matter of interpretation. She had read the reporting on the FinCEN files. $2 trillion in flagged transactions between 1999 and 2017. Major banks waving through suspect payments despite promises to regulators. JP Morgan, HSBC, Deutsche Bank.
She was not doing anything they hadn't done at industrial scale. The difference, which she knew and chose not to think about, was that she was being paid $4,000 a month to do it. The accounts she was protecting were moving $30 to $40 million a year through the bank. She knew this. She had built the picture herself from the transaction records. The money was flowing into shell company networks that fed back into construction and real estate in Campania. She had been a compliance analyst for 3 years. She knew exactly what this was. She knew exactly what she was doing. And she had developed a specific discipline around not holding both of those facts in her head at the same time. By month 8, she had a system. The transaction monitoring software flagged anything unusual automatically, amounts near reporting thresholds, unusual counterparties, velocity spikes, high-risk geographic corridors. When the software flagged an account she was protecting, she pulled the case before it escalated to her supervisor. She reviewed it herself. She wrote a resolution note, documentation reviewed, business purpose consistent with client profile, no further action required, and closed it. The note went into the file. The case disappeared from the queue. She had become the thing she was hired to prevent, not through negligence, through precision.
She knew which cases to pull, how to write the note, how to make a flagged transaction disappear into the file without leaving evidence of suppression. The resolution notes were carefully worded, factually accurate, professionally toned, exactly the kind of documentation a diligent analyst would produce after a thorough review. If someone pulled her files, they would find excellent compliance work. That was the point. That had always been the design. The retainer had become $7,500 by month 8. She put a down payment on an apartment in Hoboken. She told her parents it was a bonus. Her father said she worked too hard. Her mother said she should find time to meet someone. She sat at her desk every day and identified transactions she would have caught in 30 seconds 3 years ago, and she wrote notes explaining why they were fine, and the money moved through her bank into New Jersey shell companies, and then south to Naples and Caserta and Salerno, the same coast her father had left 40 years ago, to come here and build something clean. She thought about this sometimes, not often. She was very good at not thinking about it. The operation she was protecting ran approximately $40 million annually through the New Jersey corridor she managed. The money entered as commercial wire transfers from Italian food companies, moved through correspondent accounts, and landed in shell companies dispersed across New Jersey real estate. It had been clean before she arrived.
She had made it cleaner. In month 10, a new compliance examiner arrived for the bank's annual regulatory review. The OCC, Office of the Comptroller of the Currency, sends examiners every year. It is routine. She had been through 2 of them before without a problem because the accounts she was protecting were documented correctly. The paperwork was always clean. That was the design. This examiner was 28 and methodical in a way she recognized immediately, the way she had been methodical when she started, before she stopped being that. He pulled the resolution files for accounts in the high-risk Italian commercial corridor. He looked at 12 months of case history. He noticed that one analyst, her, had closed 43 cases in that corridor without filing a single SAR, and that the case closure without SAR rate for that corridor was significantly lower in the 2 years before she took over the portfolio. The rate had been 14%. It was now 3%. He did not confront her.
He submitted his preliminary findings to the bank's chief compliance officer and requested a meeting. She found out through a colleague who had seen the preliminary report on a shared drive. She sat in her car in the parking garage for 40 minutes. She thought about 43 cases, about $7,500 a month, about the apartment in Hoboken, about what the men who paid her had meant when they said protection. She called the emergency number.
The man who answered said to go back to work. He said not to do anything. He said he would handle it. His tone was the same tone it had always been, measured, quiet, not threatening. She went back to her desk and opened the queue. She closed 2 cases unconnected to the network and wrote those notes accurately. Most of her work was still legitimate. That was also part of the design. The trap is not complicated. It is the same trap it always is for people who have done too much to stop. She cannot go to the OCC examiner. Going to the examiner means disclosing 43 suppressed SARs, 11 months of willful failure to report, and $7,500 a month arriving in a personal account she opened specifically to receive it. The penalty for willful failure to file a SAR is up to 5 years per violation, 43 violations. The math produces a number she cannot look at directly. She cannot go to the bank's chief compliance officer. The compliance officer is already meeting with the OCC examiner. She cannot stop now. Changing her pattern, suddenly filing SARs on accounts she has been clearing for 11 months, is itself evidence. It shows she knew. It shows exactly when she started knowing and when she stopped acting on what she knew. The pattern change is the confession. She is the compliance officer. She is the person whose job is to detect exactly what she has been helping to conceal. The knowledge that makes her useful to the organization is identical to the knowledge that makes it impossible for her to leave. She knows where every transaction is, what it says, how it was documented, how she phrased the resolution note. She is the only person in the building who understands the full architecture of what has moved through these accounts, because she is the one who built the architecture of its concealment. The man said he would handle it. She does not know what handle it means when the problem is a federal compliance examiner with a preliminary finding. In her professional experience, problems that get handled tend to disappear. She is the compliance problem now. The OCC examination concludes 3 weeks later. The bank receives a finding of satisfactory compliance. The preliminary report is not escalated. The examiner is transferred to another institution in the region. She does not know how this happened. She does not ask. The following Monday, she opens the queue. 14 flagged transactions. 7 are accounts she is protecting. She opens the first file. A wire transfer, $280,000. A food distribution company in Newark. Counterparty in Caserta. Transaction narrative, invoice settlement, specialty goods. The Newark company was incorporated 18 months ago. The counterparty address is a residential street outside Naples. She writes the resolution note. Documentation reviewed, business purpose consistent with client profile, no further action required. She closes the case. She opens the next one. Her father calls at 3 in the afternoon. There will be people at Sunday dinner she hasn't seen in a while. Friends of the family, good people. She says she will be there. She drives home through the Lincoln Tunnel and sits in the parking garage for a few minutes before she goes back upstairs. The apartment is quiet. She paid for it with money she earned by not doing her job, and the job she stopped doing is the job that taught her exactly what the money is for. She has now suppressed 44 SARs. Each one exists in the system under her name, a separate federal violation in a file that any examiner or DOJ financial crimes analyst could pull on any given morning. She is 31 years old and one of the most skilled AML compliance analysts her bank has ever had, and the people laundering money through her institution know it better than her supervisor does.